And good evening all, and welcome to this RIAA Australia conference session, the 10th session we've run this year since March. Really welcome to you all, and we've got a really great session this evening or this morning, wherever you are dialing in from. A great international panel calling in from across the planet to unpack this topic around benchmarks, which I think is a really, really important one. That's an emerging discussion and conversation that needs to be had. I just want to start by acknowledging the Indigenous people upon which we're all meeting around the world, the First Nations people. Here I'm sitting in Melbourne on the Wurundjeri land of the people of the Kulin Nation, and just want to pay my respects to elders past, present and emerging. And obviously we have people calling in from lands across the world. So just paying our respects as RIAA and members of the responsible investment community to those First Nations people. So I'm here just very briefly to welcome you to this session. I'm going to be handing over pretty soon to Rachel Allen-Backus, who's going to run you through the session and moderate this evening. I just want to, as part of our ongoing conference for the year, really want to acknowledge the sponsors for the RIAA conference who have been with us along through this journey, including BNP Paribas Asset Management there, and a number of our platinum sponsors who've had really huge support to continue in this year of COVID in a virtual manner. So just a huge thank you to all of them for helping us put on these sessions and deliver this conference at a time where it's just more important than ever that we're convening and talking and continuing to unpack responsible investment and sustainable finance, and all these issues are just so important this year of 2020 and all the surprises it's bringing for us group. And I'm really pleased to have your expertise, Rachel, tonight to moderate this panel and to take over. And I'm going to now welcome you to introduce our panel and get the discussion underway, and we'll come back to the Pendle video and the welcome from Richard later in the session. Thanks, Rachel.
Wonderful. Well, thanks for that very generous introduction, Simon, and we'll be sure to leave time at the end to return to what Richard has to say. Thank you, everybody, for joining on this session today, where we investigate the uses, the benefits, the challenges, and the evolution of benchmarks in an age of responsible investing and the evolution of passive versus active investing. I'm also delighted because as generous as Simon's introduction is, I don't hold a candle to our wonderful panelists today, so I'm going to quickly introduce them. They're going to talk a little bit about their perspective on this topic, and then we'll get to some questions. We have a Q&A function throughout, so if you have any questions that you'd like to put to our panel, please do drop them into the Q&A section. I'll be checking on that regularly and interspersing your questions quite regularly throughout. So without further ado, I'd like to start off by welcoming Helena Fung, who's the head of Sustainable Investment Asia Pacific at FTSE Russell, where she's responsible for FTSE Russell's sustainable investment indices and data services across the Asia Pacific region. We will also hear from Ted Franks, who's a partner and fund manager at Pengana Capital in London. He is the fund manager for the Pengana WHEB Sustainable Impact Fund, and he helped to found WHEB Asset Management in 2009. We also have Catherine McDonald, who is the co-founder of Radiant ESG, who has a vast experience in quantitative investing, having previously worked at Rosenberg Equities. Catherine is also a board member of RIAA. So welcome to our three panelists. Helena, I'll throw it to you first for your take on this particular topic.
Sure. Thank you, Rachel. Good afternoon, everybody. Thanks to RIAA for the invitation to participate in the discussion this afternoon. So as the sort of sole representative on the panel from a benchmark provider, I thought it would be helpful if I started off by providing a bit of context for responsible investing in benchmarks, and how that fits into the broader trends towards passive or index investing. Just to give a very brief introduction into who we are as an organization, FTSE Russell is the information services division of the London Stock Exchange Group. In that capacity, we work across analytics, data, and indices. We have around $16 trillion globally benchmarked to FTSE Russell indexes. So you can see from that the sort of the scale and the scope of what we do as a benchmark provider. But just to provide a little bit of context for this discussion, I mean, benchmarks are essentially a way of measuring performance across some aspect of investment, whether that's market cap or sort of traditional fundamental characteristics. In the context of financial indexes, but as we see now a shift perhaps towards measuring companies according to ESG performance or sustainability criteria. So if we move to, so on this slide, essentially what I wanted to highlight was in terms of the development of responsible investment within benchmarks, is really, I guess, the diversity of different approaches, but also the adaptation of benchmarks to meet different investor objectives and needs around responsible investing. And I think we know that, broadly speaking, since the GFC, the global financial crisis more than 10 years ago, the amount of assets that follow an index-based strategy has grown. And I think from an asset owner perspective also, this has always been an important element of asset allocation. And I would say also that asset owners have been very important in driving the shift and the trend towards responsible investment. The range and diversity of ESG benchmarks and indices has really grown to sort of take account of differing approaches and priorities among investors. And then in terms of other segments, I think also the application into an ETF environment and the growth of ETFs from a retail perspective also makes this another very important way of channeling responsible investment into investments, but also providing choice for investors across the board. So if we move to the next slide, what I wanted to do also just very quickly is to give a few recent examples of indices that I think are interesting from a couple of different perspectives, and to give a sense of what you can achieve through applying responsible investment into an index environment. So this particular index, the FTSE TPI Climate Transition Index, was launched earlier this year in partnership with a large UK-based asset owner, the Church of England Pension Fund. And they wanted to really apply the TPI methodology, which is an asset owner-led and backed initiative with, I think, around $18 trillion worth of assets behind it, that have devised a very forward-looking approach to assessing how companies are managing the transition to a low-carbon economy across two key pillars, the management quality and the carbon performance element. But the point I wanted to really highlight here is, well, A, the forward-looking element that you can build into an index to understand how companies are managing on a trajectory and pathway towards a 2-degree or lower scenario, but also the fact that this particular asset owner, the Church of England Pension Fund, and we know other asset owners also are very keen to use benchmarks from a perspective of applying their active ownership principles into encouraging good performance among companies so that they can then be eligible as constituents of the benchmark. So for that reason, this particular index focuses on the transition and doesn't prohibit companies from any sector. So companies that are doing well would effectively then be rewarded by being included in the index. So here you can sort of see how you can combine that active ownership approach with benchmarking and applying performance standards. And if you move on to the next slide, another recent development to mention, of course, is that of Paris-aligned benchmarks. And we recently published a paper on this and simulated the impact of applying the EU criteria within an index environment. So this was based on the minimum requirements set out in the EU Technical Expert Group report published in September last year, and also the Handbook on Climate Benchmarks, which was published at the end of the year. And going back to the use of benchmarks for measuring and comparing performance, I think everyone in this audience will be probably aware of the European Union initiative to define a set of minimum standards for climate transition and Paris-aligned benchmarks. But these are labels that are really designed to help investors to improve, to understand, who want to adopt a sort of a low carbon investment strategy to improve transparency and comparability and help to reallocate capital towards climate aligned investment. So it's really about, giving transparency effectively and making sure that products do what they say they do. And the basis for this was really a trajectory for climate transition over a 10-year window beginning in 2020 that aims to reduce carbon by 50% by the end of 2030, or 7% on a year-on-year basis. So we published a study last month as to how that applies within the FTSE All World Index. And if you can move on to the next slide. Sorry, if you put up the next slide, thank you. So just to highlight that we modeled this, and the outcome was essentially that we achieved a 50% or greater reduction in both operational and potential carbon emissions relative to the benchmark universe, but also a consistent positive excess return compared to the underlying benchmark over the 10-year simulation period. And I think I just wanted to highlight also in this context that clearly we have, some significant, I would say, academic studies highlighting returns or the potential of financial returns from ESG integration. But in this context also, I think it's useful to look at the performance of ESG and responsible investment benchmarks and to see from an observational perspective, how that relates in terms of the evidence towards sustainable investment and financial returns. And if we can have the next slide. Thank you. And I'll just sum up briefly some of the things that I've mentioned here. So sustainable investment indices have really, I think, been useful in helping to scale up asset allocation towards responsible investment strategies for asset owners in particular, and has been key to implementing sustainable investment across portfolios. But we also see, I think, that sustainable investment benchmarks are useful in the broader context and have other application, maybe as a supplement to active research. And I think the other thing that I wanted to flag also was as regards ETF application and the relevance to other investor segments, including to retail investors. I think there's a lot of discussion around millennials and their engagement and concerns around responsible investment issues, particularly the environment. So in that sense, I think there's a broad application for benchmarks that can be very useful to different investor types. I'll wrap up there, Rachel, and hand back to you.
Marvelous, thank you, Helena. Ted Franks, to give it from WHEB Asset Management from the active investor side.
Hi, yes. Thanks, Rachel. Thanks, everybody, and thanks, Helena, for those good opening comments. And my apologies, I guess I'm not going to use slides. I'm just going to make a couple of sort of observations to start off with. So I'm conscious, of course, of being introduced as the person from the active side. That's fine. I'll happily play that role. I hope it's not going to be too much of a bun fight. It's certainly not intended to be that. I guess I've just got a couple of observations. And we at Pengana and Webb, so I represent Webb, a manager in London. We're very proud of our partnership with Pengana to offer impact investing in listed equities in Australia. We're a small manager. We've got just over 600 million sterling. I guess the reason that we might be relevant for this conversation, or particularly relevant for this conversation in terms of responsible investment, is really the first of the 3 points that I want to sort of talk about, and I guess the most important one from an active management point of view. And it seems funny to say this now, but benchmarks were originally devised as a useful tool to prevent asymmetry between asset owners and investment managers, right? To stop managers pulling the wool over asset owners' eyes. And that is a very useful and powerful and important thing. And there's no question about that. As we'll come on to a bit later, they've morphed into this quite different thing, which is that they are the first point of capital allocation globally, which is quite a thought in itself. We'll come on to that in the sort of second of my points. But on the first point still, if you're still thinking about this asymmetry idea, I guess the point is, we at Webb, if there's a reason for me being here from Webb and Pengana, it's that we've always been pioneers in trying to go through the transparency route. We were, the strategy has a long history, the first global strategy to publish all its holdings and why we hold them every single month. We've always published the minutes of our advisory committee. We've engaged with any investor who wants to talk to us about what we do. We've had a series of events going back, this is over a decade now, where people can talk to us the whole time. We were the first listed equity strategy on the Global Impact Investing Network and the first to launch an impact report. That report has subsequently had other innovations such as our impact calculator and this year our impact engine. There is nothing we don't do which is about transparency. There's nothing we do which is not about transparency and about communication with our investors and making sure they understand what we're doing. And I guess our point is, in responsible investing, that's super important because actually the details really matter. And that is your alternative to having the benchmark help provide that asymmetry difference. And I guess I would say, and obviously not wanting to sort of put it out there, in a way, benchmarks are perhaps not so helpful here because you can create a sense for an investor using a benchmark that the ESG benchmark has captured everything there is to capture about the ESG aspects. And when you look at the range of products in the market, as we periodically do, although I must say we never really get asked about using them because I think investors who invest with us can see immediately what they're getting. It's always striking to us that the available benchmarks are still quite a long way from, I think, what a responsible investor, an individual responsible investor would be thinking of in the first instance. And that speaks to how they're created and what they're created from. So I guess my point would be, there is a job asset managers can do which can help overcome that asymmetry which benchmarks solve. So if that's my kind of big opening gambit, the other two sort of areas to just sort of mention before I pass on again is, obviously, and this is not where I have a particularly superior insight, but clearly benchmarks, the first of them, this idea of capital allocation, that they have become the starting point for capital allocation. And that's why it's so important that Helena and her team and everyone at FTSE who runs the benchmarks is doing the best job they possibly can to make sure that capital allocation is being moved as quickly as possible towards a more future-looking approach and helping us to solve the huge issues of sustainability. But again, I would highlight, there are problems inherent in the construction of them, particularly this starting point that you must have everything in the index, and that deviations from that are in some way dangerous, which means that you get into this quite interesting situation in terms of capital allocation. And then the third point is, of course, to think about, so if in a way, you can think about these points, for the investor on the point of asymmetry, for capital markets on the point of the allocation point, and the third is kind of for companies in a sense. And that's really, where does it leave us in terms of how those companies are managed, and do we have genuine active ownership? And I am hugely encouraged by the path that this has taken. I think it's interesting that Larry Fink can spend a decade very carefully not having an opinion on anything and being passive, and then he can suddenly become the key advocate for doing something, which is interesting, but at least he is apparently keen to do that. I would observe that in our small portfolio, when we analyse the results of the proxy votes, which we all do as internally in our investment team here at Penn Garner Webb, it's an important part of being an active owner. It would appear to us that we still have the bulk of the passive industry on what we would consider the wrong side of a lot of the engagement, certainly in terms of governance. Now, other active engagement that's going on, obviously we're not privy to, but the potential there is huge. I think we would like to see that industry move forward a bit more. It's still too easy for company management teams to get away on the proxy votes. And of course, as proportion of passive increases, if that doesn't change, then there will be a sort of kind of permanent problem here, which is that management will effectively be able to count on more than 50% for most of their votes. So I don't know if that was helpful, but that is the world as I see it, and I will let someone else add a bit more value.
Marvelous. Thanks, Ted. Catherine, from your particular perspective at Radiant ESG.
Sure, and I'd like to pick up actually where Ted started as well, and just say that we see that the role of benchmarks is changing, and it has been changing for some time. Benchmarks have gone from this, yardstick that put a premium on transparency and comparability into these very complex things that really can only be described as active investment ideas. And this has some consequences, which I'd like to come back to. But with respect to ESG benchmarks, I think we're making progress on a number of fronts, though this complexity issue, I still find challenging. And again, I'll come back to that. But we seem to be generally moving away from these very divestment-focused approaches to benchmarking. So let me use the example of climate-oriented investing. This, the first generation of climate-oriented benchmarks were, really just examples of carbon minimization in which high polluters and even, whole sectors were summarily pushed out of an index in order to, pretty drastically reduce that index or that benchmark's emissions footprint relative to the broad market. There's no question that, benchmarks that have rejected big polluters have done, pretty well in performance space, as we've seen these big sell-offs in oil, over the last couple of years. But the fact of the matter is that they have been wholly divorced from real economy efforts to wean ourselves off of fossil fuels. And I think also importantly, by not holding exposure to the big polluters or the polluting sectors, they've effectively relinquished the most powerful impact tools at their disposal, voting and engagement. So this, what I would describe as this next generation, of climate-focused benchmarks. For example, the EU climate transition benchmark, the EU Paris-aligned benchmark, which Helena referred to earlier. Most recently, this net zero benchmark that's backed by the IGCC. These attempt to more directly relate investing to real economy outcomes. They do have some divestment aspect to them, but they are also focused on inclusion and speaking to and getting upside from the transition to a more green economy. They also tend to require exposure to the big polluting segments of the market. A couple of them, you know, the net zero is the best example, I think, also put a very, put engagement kind of at the center of how they link investing to real economy effects. So in this way, I think this next generation of climate benchmark really does get us a little bit further down the path towards actually achieving, helping achieve Paris alignment, or helping achieve, you know, some of these UN Sustainable Development Goals in a way that those first generation, you know, just sort of low carbon, restrict oriented benchmarks could have never done. But where I do have concern, again, is back to this idea of complexity. You know, these next generation benchmarks are as complex as any active investment strategy. And so the two concerns that come to mind really are, number one, you know, can they effectively serve as benchmarks? They would seem to violate several of these long-held benchmark ideals that we've sort of all grown up with. Measurability, unambiguousness, accountability, you know, these seem to be somewhat missing in these, you know, hyper-constructed benchmarks. I think more likely they will be employed as investments themselves, you know, really in the form of ETFs or, you know, other sort of index tracker investments. But then the question becomes, who actually bears responsibility for the investment outcome of the benchmark? The index provider, the index creator, typically wouldn't take fiduciary responsibility for putting an index out in the world. An index replicator or an ETF provider would probably believe that their responsibility ends upon their faithful replication of that benchmark. And so that leaves the end investor kind of holding the bag on the investment outcome of, again, what can only be described as a very active portfolio of ideas. And I think that this ambiguity is something that could potentially lead to real problems. And so while I think that these, you know, more sophisticated benchmarks have come a long way in terms of linking investing to the real economy, I think it's the complexity that may ultimately be a challenge for us in our work.
Thank you, Catherine. I think I'm going to jump straight into a question from the audience because that neatly sort of piggybacks onto what you were just talking, or all three of you were talking about. So regarding the idea of passive or benchmark investing, academic evidence suggests that the opinions of third-party ESG rating providers do not agree with each other. Ergo, how does the industry go about choosing the ESG index with the highest efficacy? And I think that sort of neatly goes to all three of the concepts that all three of you were talking about, on the idea of resolving asymmetry, improving transparency, and going towards accountability. So I'll throw it open to all three of you who wants to take a first stab at this.
Maybe I can answer that question. It's something that comes up fairly regularly, so I feel fairly well versed to answer it. I mean, I would say there are a number of different providers. We obviously are one of those. We rate companies for the inclusion of, for their inclusion in our ESG index products. So we rate them according to a number of different metrics. You know, I think there is diversity of thought and opinion in the market. I don't think that in itself is an issue. I think it's really, you know, as with any financial measure or reporting, it's really about investors knowing what they are investing in, reading through the methodology, satisfying themselves. I would only say from FTSE Russell's perspective that we do try and make everything as transparent and objective as possible, and we publish the methodology both to the companies that we rate and to the users of the ESG ratings and the indices and so on. So, I think that the diversity is not in itself an issue, but I would just say, everybody needs to know what they are investing in and the criteria that are being applied. And I would just encourage investors to sort of really familiarize themselves. And from that point, it's about making a decision as to which is the preferred approach. I'm interested to see what the other panelists can supplement that with.
So I guess from my perspective, I will say that, again, and this comes from a quantitative equity background, but I will say that ESG and information related to sustainability, I think we can only partly rely on a quantitative approach. So we've got all of these different scoring systems that are, black boxy in their own way, but lead to, not perfect alignment at the highest level on what makes a good ESG company versus, what makes a poor ESG company. I do think that there should be some qualitative expertise that's brought to bear, which I think would make it then very challenging for an index provider to, put out an opinion or, build a benchmark full of stocks or an index full of stocks that, that has deeper research tied to it. But I do think that there's a heavy room for qualitative in ESG. The other thing that I would tend to focus on is really going well beyond these ratings that the different houses have, and look at the actual KPIs of the portfolio. What is actually achieved? What are the outcomes? And so going beyond diversity score, for example, and moving into what is the percentage of women in management? What is the percentage of women on the board? Real tangible outcomes. And I think that then gives investors, a much cleaner and clearer view of what they're buying, and it really makes sure that the index is, again, achieving what they've set out, what they've promised to do.
Yeah. I'll try and make this brief because there's so many good points about this. Of course, we can go into this in more depth because it's kind of key, but great points exactly from Helena and Catherine. Just kind of echoing on our side, as someone who is on the active side trying to do this in-depth research, trying to really understand these stocks, my observation would be in the current mode of passive and quantitative and benchmark investing, it has always struck us that there is this built on sand problem. And whilst there is diversity in the ESG ratings, I would also, I'm afraid, say, much as we like those organizations and they've been hugely powerful and they are our allies, there has always been this quality problem for them because they don't have the money to invest in doing those research. Now, in recent years, with the growth of ESG, they've been able to improve. But the reason I call it castles on sand is, and we met this a few times, it's been around for our strategy has been around for 16 years now, but you quite often come across people who are saying, I want to put together something quant, but what I need is the data. So I'm a quantity person, a PhD in maths, and I like little data points, which are stocks. Just tell me which are the good ones and the bad ones. And then I'll do something really whizzy and complex with that. And that's the wrong way around, because what you want is the in-depth research at the company level where all the real important complexity is. And then you kind of want the layer above to be simple, whereas what we've got tends to be thinly and underfunded research here, and then a lot of layer of complexity on top of it. And that obviously is what results in these perversities when you actually see what comes back in terms of, okay, we've done all the great stuff in terms of weighting this risk relative to an existing benchmark. But then when you look at what they actually hold, you say, well, the problem you hear is you built it on sand because these actual companies, you've had to skirt over these huge issues. And of course, the key problem there is the whole of the benchmark and passive industry is built on a gospel of cost. So you're not going to pay someone to do the proper research at the coal face. And that I think is a problem which I don't want to over exaggerate it, to be fair, because they've come on a long way and there's some good things being done. And actually the exceptions, we've had this wonderful exception just recently with Boohoo here in the UK, which was top of all the ESG rating scores and turns out to have been pretty terrible. The exceptions are actually quite rare now. So it's not, me saying built on sand is a bit overstating it, but that is kind of the fundamental problem with it. If you go for cost, then at some point quality of research has to give.
To that point, I'll take a question from the Q&A section that I'll take as a comment. Adam noted that with the different ESG research providers, so many of them had favorable scores for Boohoo, the fast fashion company, and so therefore the question becomes, what were these third-party evaluators overlooking in their process? Adam, I'll take that as a comment rather than a question, unless anybody wants to weigh in specifically on Boohoo.
I will weigh in, not specifically on Boohoo, but I think that this is a very good example of why we need standardized, required, timely information. You know, the Boohoo fiasco was really about supply chain for the most part, but you know, to the extent that we don't have regulators that are requiring disclosure of ESG related ideas in the same way that we require, you know, we have certain requirements for financial accounting. I think that we are going to, you know, continue to struggle on this. And that's not to say that there is some magical disclosure system in which everything will be disclosed, but we can at least start. And if we start requiring companies to disclose in a way that it is timely and auditable, I think that the whole industry will move forward in that way. And I'm especially sensitive to being the American on the panel, and it is our regulator right now in the United States that is, you know, not just dragging its feet, but has its head positively in the sand on this stuff. So I think that there is a lot of room for improvement, both in terms of the kind of discovery that we employ as active managers, you know, this idea of you know, mosaic theorying our way into good investments, but there is definitely a role for the regulator to play.
Well, I have to just add to that and say I think that's a very fair point, and that essentially, you know, access to the information and disclosures continues to be something that is often discussed and is still important for investors. And I think we assume that in the UK you have, and in some of the more developed markets, you have a better quality of disclosure, but I think it's something that as investors and as those, you know, involved in this industry and in responsible investment, we still need to keep up the pressure on and to encourage from companies, both individually and from a regulator perspective, as Catherine says. But I think certainly, you know, encouraging that from companies specifically, and that level of transparency remains something that, you know, it's often spoken about, but it's still a core tenet for any investor wanting to apply an ESG or responsible investment approach. You have to have the data, and it needs to be, you know, meaningful and verifiable, and that's always a challenge, and remains so, as this example demonstrates.
I'll jump to.
Can I?
Oh, please.
Sorry, I know we've got lots of answers things, but can I just add one little thing to that, which I've often thought about? That's so true. Obviously, that's our life, right? Trying to get the information out of these companies, trying to make decisions from it, then trying to communicate it to our investors. I would just propose a slight thought experiment. If we were trying to do that, if we perceive that there is a big shift towards sustainable investing as attitudes have changed, and you know, grant me that that's my premise, and I hope that you agree with it, it seems to me that there's a new generation of investors who are much more aware, which is to do with the big societal shift. Imagine if this shift towards being more thoughtful about the impact your money had happened in an era where there was multiple active management responding to that. And I actually don't know, I'm not proposing that it would therefore be a lot better, but I would just observe, I think the pressure, to me, it feels like the pressure that could have been exerted on companies to disclose more would probably have been greater. I mean, discuss, but that's my sense. Instead, actually, that pressure to try and get companies to disclose stuff has slightly hit a bit of a barrier in the fact that there's this big passive layer protecting a lot of the companies from their shareholder base.
I'm not sure whether you want me to respond to that or not. I mean, I guess this kind of goes back to what we started to discuss at the outset of this presentation. I mean, I think, frankly, Ted, that there's a role for, there's a role for active here and there's a role for passive here, and I think both are very important. And you're right that in the research there's two different approaches, and certainly, I guess the scale of passive is very important. And equally the contribution of active managers here and the relationships that they have directly with companies that they can leverage and bring to bear. Really, it should be a virtuous circle, and I think both approaches, have a very important role to play here.
Yeah, sorry, that came out way stronger than I expected it to be clear. At the end, I end up saying you've got a big barrier, like you're some sort of castle protecting these guys. That is not what I meant. I'm sorry. It wasn't meant as a thought experiment, but it is an observation that I've had that anyway, who knows? Active managers could have been the old bad active managers not interested in any way. That could have been a problem in itself. I'll stop.
The other aspect to stress here, of course, is that the investors, even within a passive pool of assets, there's still a great opportunity for the end investor and to the beneficial owner to be able to use passive assets as a leverage for engagement. That's another very important part to highlight. Yeah.
I'll pull into that then to talk about to bring in a question on the retail side, bringing in a question that Dave Ray asked. Hi, Dave. Hope you're doing well. Benchmark-based products, such as exchange-traded funds and exchange-traded products, have proven really attractive to the retail market. Research from my company, Rainmaker, that was recently concluded proves that the assets under management in the Australian market for exchange-traded products with an ESG characterization have trebled from 2017 to now, from 1% of the market to 3% of the market, representing 1.8 billion of the assets under management. What role do benchmarks play for the retail investor? There's obviously a huge amount of hunger in the Australian market. We can discuss reasons for why. Bringing some of the points Ted makes about the pressure from people to disclose this kind of information or to have this alignment to decarbonization or respect for human rights. What role does a benchmark play to meet this retail demand?
I think that I'll go ahead and start. I think that these kind of ESG benchmarks, and then again the exchange traded products that are leveraging off of them, are enormously appealing to retail investors because they often are thematic in nature. And I think that this is something that as individuals we really gravitate towards, and I think that they appeal both from an investment standpoint and increasingly from a sort of a values orientation. I think the challenge of bringing these to retail investors, again, back to this idea of complexity, is that these are truly active strategies that are called benchmarks or called indices. And I think that there is this conflation between the idea of something that's an index and something that's passive. And I'm sure that those of us on this panel could argue for the rest of the day about what's passive and what's active. But for a retail investor, the takeaway is that their investment performance in any given year or any given quarter may be quite meaningfully different than the performance of the broad shares market. And so, to the extent that we can make sure, as best we can, that the end investor understands that and is comfortable with that, and their risk tolerances are appropriate for that, then I think that this is nothing but a good thing in terms of vehicle type allowing them to get exposure. The one thing that I will caution, though, is that the more sort of specialized and esoteric some of these ETFs get, like China only ESG leaders or solar power or wind energy, the more expensive they are. And so I think that the retail investors really need to be looking very carefully at what those fees are. Certainly there are some that are very inexpensive, but again, once you start getting into more specialized kind of strategies, the fees really go up meaningfully, which then itself eats into performance.
Just to add to that, I wouldn't say that the ETF market is exclusively for retail investors. I think we see a lot of large institutional investors also making use of some of the advantages of investing through an ETF. So in terms of the complexity, I mean, there are such a range of different products, from straightforward exclusionary products to as you say, some of the more complicated or sophisticated thematic ETF or index products. So I mean, you're correct, Catherine, that it's really for the investors to understand. Investors need to understand what they're investing in and what their exposures are. Often, a lot of returns are driven by benchmark universes, so that's something else to mention also. But it is important that retail investors understand the differentiation between the returns to a benchmark and the returns to an ETF, which can vary. But I think on the whole, what we see is that we see engagement from the retail market, from investors. They want to have exposure to the better managed companies or those with better ESG or lower carbon profiles. I think I have to agree with Catherine that having that element of choice and allowing people to express their views alongside their investment criteria, is important. There are such a range of different products. It's not only about complexity. It can also be, fairly straightforward products that I think are very useful for a range of different investors to have exposure to.
I'm sort of wondering if we're not imbuing the term benchmark with more qualities of what we were talking about before, that transparency, that accountability, that authenticity, and whether or not we're asking benchmarks to encompass those terms, which might cause confusion with sort of a retail market. Ted, I wanted to particularly bring you in on this point because I'm thinking of what you were talking about before, the impact calculator and now the impact engine that you've utilized as someone who's been a consumer of those through the years, and the way that you've tracked impact and you've tracked the way you've reported to clients. Are there ways of demonstrating to the end investor, to that the impact, the measurement, the transparency of the process without needing to have a benchmark approach?
Well, I mean, thank you, Rachel. Yeah, I mean, just to sort of kind of reiterate my earlier comments, I mean, that has always been effectively our. So how to put this? Our intention was not to set out to create something which was the alternative to benchmarks. Our intention was to try and communicate directly to the investor, if you see what I mean. It was kind of a pure kind of straight across. And we benchmark ourselves against two things, the MSCI World, and here in the UK where we're based, the Investment Association Global Peer Group of Funds, which are actually just general, all market mainstream. And it helps us build this narrative, which we spend a lot of time doing, trying to build a narrative about how we do the communication. So it is possible, but I mean, to hopefully not be like the guy who just seems to try and beat Helena up the whole time. There's definitely a very good point why a lot of investors, if they're looking at a cost angle, if they're looking at a simplicity angle, then it is useful for them to be able to have benchmarks which express their view. And I'm always very cautious. If I meet friends and acquaintances who are interested in my fund, I obviously tell them all about it and I'm very enthused. But I do always say, we're for people who really believe this stuff and really want to be connected to your money in a sort of significant way. And we kind of want you to invest a bit of time to see what we're doing, right? We're very careful and very risk aware. It's not like we're then going to take that license and run off and do something crazy with it. But that's the intention. Of course, a lot of investors, particularly retail investors, don't have that level of motivation. You've got to respect those people. And therefore, there's clearly a role for a well-constructed, affordable, entry-level product, which has got a risk rating which fits into the framework of how benchmarks work. But I mean, yes, so the short answer is yes, there is a way around it. We're trying to do it. And it's quite big. It takes quite a lot of work, right? And we've been on this little train of ours for a little while, and I can tell you how to put this. I mean, no one is creaming off a rich fee and making a fortune here about this. This is going back into doing this hard work, and it's obviously a little bit painful for us. The industry is continually saying, "Oh no, you don't want to pay for that." So, sorry, that's my little sort of end on that.
A couple more questions from our audience. In terms of, oh, this is a good one. What does the panel sit on the role regulation can play in holding active and passive managers accountable for their marketing claims versus actual outcomes? Catherine, you spoke a little bit about the role of the SEC wading into the responsible investment debate. Might be good to get an international perspective on this particular question.
Sure. Well, let me pick up where I left off by saying that we've got, our regulator, the Securities and Exchange Commission, seems quite loath to require companies to report anything on ESG, and yet they've been, quite vocal about wanting to go after investment managers who may be, greenwashing or otherwise tricking the public. I think it's very interesting how we see this playing out in different parts of the world. We generally see Europe as being more of a regulator-led, top-down, let's establish some definitions and try and protect the populace, as opposed to the United States, which historically has been very bottom-up, every person for his or herself in terms of understanding this stuff. But I do think that in the same way that we have basic requirements for labeling, especially within the retail sector, that should absolutely extend to objectives that are related to ESG outcomes and impact outcomes. So in every prospectus for mutual funds in the United States, there are several standard sections. Now we could think of how to slot ESG and impact into those sections where we talk about prospective risks and prospective sources of return, or we could just have another separate section that has to do with ESG and impact. And I think that by adopting a common language that's used in the retail market, and by having some very strong leadership, not with the eye to overregulate, but with the eye to standardize, we would really be doing retail investors especially a favor in markets that have been less regulated historically.
All right, another couple of questions then from the audience, and then I've got one final one I'd like to end on before we throw back to Simon. One towards you, Helena. Despite reporting challenges, do truly global benchmarks merit the inclusion of a higher number of emerging market constituents and perspectives? Which sort of picks up on what we were talking about before about the availability and limitation of data upon which these castles are built.
Sure. I guess this goes to the fact that at FTSE Russell, we have just completed our inclusion of China A shares into our global equity index series. So I suppose it's sort of relevant from that perspective. We've also extended our ESG capabilities to meet that as well. Look, without wanting to address China specifically, I would say that in general, there's some really interesting ESG developments within emerging markets. So I wouldn't sort of say that that emerging markets overall are necessarily underperforming in terms of their ESG profile. And I sit in Hong Kong and I cover APAC, which obviously contains a number of important emerging markets. I see some real efforts here, particularly among the regulators, to really try and drive forward the focus on sustainable investment. So I would really encourage people to look at maybe some of the activity that's really going on in emerging markets from a sustainability perspective, and to consider that. I think really, from an index perspective, you should consider your investment criteria and how that fits with, in terms of the exposures that you want to have, and then the ESG or the sustainability criteria then should tie in with that. But when you're constructing a benchmark, you're effectively looking at those companies that are performing better. So you would likely have a greater exposure on a company level to better performing companies, I would say, overall. So, I think from an emerging markets perspective, for ESG investors, assuming many investors, particularly on the institutional side, have a global lens and exposure, I would say it's still very important to have a presence and to be active in terms of continuing to encourage better standards, and in particular tying that in with some of the active ownership initiatives that are going on. You know, we have some really great initiatives in this part of the world in terms of the emerging market economies, but also still some challenges. And for investors to be present and to encourage development there and to show their commitment to those markets, I think is a very important part of engaging in that dialogue and encouraging progress.
Another question, this from Cassandra Williams. Do you think that institutional investors have an appetite for a greater tracking error, i.e. greater than 1%, for funds that are differentiating themselves by their responsible investment strategy? The old conundrum of the tracking error. Anybody want to take a stab at that?
Well, I will say, you know, my experience is that yes, absolutely. I think that we have tons of institutional investors who, you know, we'll even start the conversation by saying, you know, look, we don't want to focus on tracking error at all, or not nearly as much as we did in the past. I think part of that is a function of having come out of, let's say, you know, last 4 or 5 months notwithstanding, but before that, we were in an exceptionally low period of cross-sectional volatility. So, you know, tracking error, you know, definitely wasn't high in many strategies, at least in the way that it might have been in a prior period with greater volatility. But I think that there is a greater appreciation for, again, the activeness, in air quotes, of some of these ideas and how purposefully different these investments should be from a cap-weighted benchmark or a cap-weighted starting point. You know, so most institutional investors come to the project with an aggregate benchmark that looks very market-like, very cap-weighted market-like, and they're really seeking an investment that is, again, meaningfully different along certain dimensions than that passive aggregate benchmark.
I could just very quickly add to that and say absolutely yes. And I, you know, see a lot of instances of institutional investors prioritizing meaningful impact outcomes from ESG metrics over reducing tracking errors. So the answer would be yes, I would say.
All right. And then one question I wanted to sort of leave on before we throw back, in terms of the how can benchmarks and the topics that we've been discussing be integrated with that strong fiduciary approach that responsible investing represents, particularly as it relates to the tools of active investment, the proxy voting, the engagement, things like that. Do you have any thoughts on how this all fits together into that greater body of work around responsible investment?
I wanted to give somebody else a chance to pick this up, but maybe I can just briefly say, I mean, I talked about the TPI transition benchmark in my short presentation. I mean, you know, I think benchmarks have a very clear role to play in terms of a platform for engagement, and even more so, I would say, in terms of the development of new benchmarks. We know that's really important to investors, and that it's something that they want to tie in with their active ownership approach. And additional to that, you know, my own background is really in engagement and responsible investment, and having a pool of passive assets does not preclude an investor from then using that as leverage for their engagement, and indeed for setting out their own voting criteria. Of course, that requires the buy-in of the manager. But yes, I mean, passive lends itself absolutely to a responsible and active ownership approach.
Yeah, I think it also, you know, what would be very helpful is a change in mindset from the biggest of the passive managers. And Ted brought up Larry Fink's missive to companies of a couple of years ago that they need to start changing their stripes. But what we still see from BlackRock, from Fidelity, is, you know, pretty poor voting records when it comes to supporting initiatives that are related to environment, when it comes to requiring really tangible or quantifiable achievements on the part of management or the board. You know, there seem to be willing to support sort of nebulous, you know, anticipatory truth statements on the part of companies, but anything more tangible than that, Fidelity has openly said that they won't support. So I think that, you know, there is absolutely no question that it's these behemoth passive investors that have this very big stick to swing if they choose to. And so, you know, I would like to encourage them on behalf of us all investors and the economy and society at large, to really start using that power when it comes to voting. They do tend to kind of talk a big story on the subject of engagement, but again, that's a little bit opaque to the rest of us. I think that they could definitely do more on the voting front and, you know, probably on the engagement front as well, but that's, again, a little bit less obvious.
And I agree with all that's been said previously, but I guess the observation would be, you know, the thing about engaging with the company is at the end of the day, the big tool that you possibly have really in listed capital markets is divestment, obviously, from that company. And so you can almost put engagement into 4 buckets. You've got, and I haven't really given this constituency enough of a kicking, so I'll do it now on behalf of Helena. There is bad old active, right? It's out there, and that's bad. So if you have the tool and you won't use it, that's not great. Okay. If you're passive, you know, and you don't have the tool and you won't use it, that's like really bad. If you want to engage, but you haven't got that key tool, that's still good, and you can still, exactly as Catherine says, we would still like to see more from these universal owners to use the power they have, even though they don't have the big stick at the end of the day. And then, of course, you've got hero of the day, us, you know, active managers who want to be, what a surprise, who actually want to be owners and have the power to finally back it up with some action in the final analysis as well. And so across the piece, everyone needs to do their bit to move it. And so long as, I'm sure as Helena would endorse, so long as you get the right combination of active and passive strategies to try and make these things happen, then we hopefully move in the right direction. The very last thought I would just say is, just from a pure kind of democratic point of view, I do find it tricky. You know, BlackRock and those guys, Fidelity, the big three, they are at the moment preaching the right gospel. And I always just remind people in our industry, even though they're not acting on it, just imagine if they weren't on board, because they would still have that much power, right? So saying it's great, they're so powerful, they could do something great. They could potentially be a real problem if they weren't even minded. So just democratically, it's a question, isn't it? And that's more about the fact that there's so much concentration in just 3 providers, I guess. And I will stop now. Sorry.
That's it. A great starting point. I hope everybody will join me in thanking our panelists on this. Ted Franks from Pengana Web, Helena Fung from FTSE Russell, and Catherine McDonald from Radiant ESG. Simon, back to you.
Thank you. Thanks so much. I really enjoyed that discussion. It's launched a whole lot of questions in my mind that I want to keep digging into, but I really, yeah, thanks so much for that. Those frank and honest debate and discussion. It's a great one. I feel like it's one that we are probably at the start of grappling with and has a long way to run yet. So I'm really keen to see where that goes, particularly when I think of an S&P ASX 200 is probably currently on its market weighted index, probably aiming for a 4 or 5 degree warmed world. There's a lot of work to be done to ensure we're measuring our performance against the right index and benchmark. So I think it's really great. So thank you. And we are going to now just finally, I really want to, we're going to try this again, the technology, and hear just briefly from the CEO of Pendle Australia, Richard Brandweiner. So let's try this one.
My name is Richard Brandweiner and I'm the Chief Executive of Pendle in Australia. These are very challenging times, but they remind us of just how interconnected our world is, how our economy and... My name is Richard Brandweiner and I'm the Chief Executive of Pendle in Australia. These are very challenging times, but they remind us of just how interconnected our world is, how our economy and our financial markets are intrinsically linked to our human ecosystem, and also how important it is the decisions that we make and how we treat other people, what the ramifications are. And that's perfectly true with our capital, our wealth as well. The way we invest can make a big difference to the world around us, and importantly, the world into which we or our children are going to retire. And that's one of the reasons why we're seeing such extraordinary growth in sustainable and ethical investing. Consumers are increasingly demanding different things from their service providers. It's no longer just about what product or service you do, it's also important about how you go about doing that. And impact investing in particular, but sustainable and ethical investing has become the fastest growing part of the investment management industry. Pendal's been in this space for a long time. We launched our first ethical fund back in 1984. And more recently, we fully acquired, a business that we helped establish called Regnan. It's one of the leading institutional providers of ESG research, engagement services and advisory work. We're very keen to support you in the journey towards an increasingly sustainable capital system and towards empowering your clients to invest in positive ways that makes them proud, together with growing their wealth and their family's wealth. Thank you.
Great, and a nice way to close it off there. I think that sort of pulls things together quite neatly. So thank you all again. Apologies for the small technical glitch. I can tell you it's run a lot smoother than watching 7-year-olds sitting around a conference call doing homeschooling at the moment, as they are in many parts of Australia and the rest of the world. Ted, enjoy the rest of your day. Helena, your afternoon. Catherine, your nighttime, and everyone in Australia, your evening. Thank you so much for the contribution and for joining us today. And I really, look forward to continuing this discussion. So thanks very much. Rachel, very much thank you for moderating tonight's session. Okay, have a good evening, everyone, and good night.
Thanks.
Bye-bye.
Thank you.